Welcome everyone to this very important video. And today we are going to look into what I promised for quite some time, for over a week now. We are going to look into Tesla options strategies. So this video is only for people who are very bullish on Tesla and who are a little greedy and who are not happy with just having a lot of shares. So first of all, very quickly, what is the macro situations on Tesla and why are we all getting a little greedy and nervous here? Well, the situation of Tesla is the following. Here is the 5-year overview. We saw in 2021, it went up to 420 roughly, and then sidelined or went sideways for a very long time, right? For 1, 2, 3, 4 years, nothing happened while the company was going through the roof. Massive expansion, massive technology improvements, FSD breakthroughs, all these things happened, not reflected in the stock. So then Trump got elected, Elon got a little political. The stock went suddenly up a lot from actually its lowest point from 147 all the way to 480 in 2024 in November and December 17th it peaked. And since then, we have seen this insane drop. Now, the insane drop is a function of mostly the market macro situation with the tariffs scaring people, blah, blah, blah. You know the whole story. But now we probably have reached the bottom of 222. And why is this so important now? What is important, right, is in this short-term setup, 225, 222, somewhere here was the bottom. I went up to 288 very recently last week, and is now sitting around 260, pre-market nicely up. Why are we so excited? So here's the big picture. April 29th is coming up. This is the Q1 earnings call. Everyone knows it's going to be bad. I think Pagey estimates like 350,000, sales units delivered. So whatever, like we know Q1 is bad. Everyone has priced it in. No one really cares. The Model Y is back. Afforded models are coming. This is all nice, but it's about Robotaxi. It's about the launch of the Robotaxi in Austin in June, and the question if that actually will happen or not. And I will show you quickly here the actual model, the Tesla model, and why this is so important. So if we look at the meaning of Robotaxi for the entire company, it is so important. Here's my little model. You can get this on pioneerlands.net. In the description, click on a link. You find the models there. You have to become a citizen first, $9 a month. Then you can access the models. If you don't want to pay, you can still participate in all our discussions and contribute and see some intel. But here's the model. And here's the Robotaxi revenue stream. And if you look at the projections, they're pretty reasonable in terms of unit growth, but you see the EBITDA potential. And we are talking about $109 billion in EBITDA, and profit that is added by Robotaxi by 2030, and then going exponential from there, by the way. So you see 109 billion in profit compared to currently 12 billion a year for the entire company. So Robotaxi alone can 8-fold the profit of Tesla, and that's not even taking into account other things. So clearly, this is a transformative moment, June. And the question is not for anyone who's straight thinking and knows anything about the opportunity, the TAM, and the tech. The question is not if Tesla can make actually trillions in profit through autonomous robotaxis. That's not up for debate. That is obvious. The real question is, are we now at the point where this is starting to happen, or do we have to wait another few years? And the indications are that June is actually happening. So the all-decisive questions, you need to answer 2 questions. Do you believe that robotaxi and autonomous vehicles will take over the world and basically become the primary mode of transportation? You don't need to be a rocket scientist to say yes to that if it works. The second question is, when will it work? To the extent necessary to replace all transport. That is the big question. Now, Elon implies it's now. Elon implies it's in June where we launch robotaxis in Austin, where everything's going to change. Now, Elon has said this for 10 years and was wrong every year for 10 years. That tells us 2 things. We cannot just rely on Elon, and at some point he will be right, of course. And the longer he's wrong, the more likely it becomes he's right next time. That's the nature of progress. That's what most people don't understand. But this time we have a lot of other people also chipping in who are a little more reliable than Elon with timelines, right? We have Franz. We have the head of engineering. And now we have the official Tesla team and account on X saying we are on track for June. And if you look in the calendar, it's April now, June. That's not very far off. That's 10 weeks roughly. It's 8 weeks, right? So if you're 8 weeks away from a major launch that includes all kinds of testing, millions of miles needed, the cyber caps being tested in Gigafactory Austin and deployed, and the regulators in Austin working every day on this stuff, and you need all the approvals ready, and you're 8 weeks away, and everyone is doubling down on the timeline internally who works on this every day and says, yes, it is happening in exactly 8 weeks. At some point, we have to start believing this, right? So this is very interesting. So the bottom line is there is a lot of evidence that this crazy thing here, this crazy revenue stream that would make Tesla the largest company on earth by a big distance very quickly, right? Who can easily add 100 billion in profits and then 200 billion and then 400 billion? No one. It's only Tesla. So if this is really happening, we need to get prepared. We have to get out of our little, dream state and say, well, now is the time. Now it's really happening. If we are sure, and we are not totally sure, but we're becoming more and more sure that this is a thing. So I want to start looking into what we actually can do about this, right? And I basically have what I call the 4 greed scenarios. How do you execute greed? So let's say you're very greedy. And I always use this 1,000 Tesla share portfolio as a reference to make it simple. Let's assume you have 1,000 shares of Tesla and you're all into Tesla and you don't have more money. It's already all in Tesla, but you're not happy. You want to be more greedy. What can you do? And I outlined 4 greed scenarios how we can capitalize on this. They all are very dangerous. So I will go into the risks and upsides for each of them. So the first scenario you can do is you can just apply leverage. Right? Forget options. You just have 1,000 shares or an interactive brokers or some other, account that allows you to trade on margin, and you just buy another 1,000 shares. Just buy it, and you see your cash, going down, and then you are in debt, $260,000 negative, but you have 2,000 shares of Tesla, right? And you are paying not too much interest, hopefully, but you're leveraged. Now, the problem with that is, well, first of all, it is an option, right? You can do that. Here's the problem with leverage. You have 2 problems. Number one, your leverage amount is limited, right? If you're very greedy, you're not going to be happy. You have 2x. Tesla goes up by 10, right? Instead of making 10,000, you make 20,000. Great. But you wanted to make more. 2x is the maximum you actually can get, roughly, right? You cannot go 5x because the broker is not going to allow that, right? You can go 260,000 in debt if you have 260,000 assets, but you can't go 1 million in debt. They will just not allow it. So you cannot do much here. You can 2x maybe, and then you're sitting there. The risk you're taking with regular leverage, besides not being, not having a lot of leverage up, on the downside is you have hard risk, right? If Tesla goes up 10, instead of making 10,000, you make 20,000. But if Tesla goes down 10, instead of losing 10,000, you're losing 20,000. In other words, if Tesla goes down 50% from here to 130, which is kind of impossible, but who knows? If Tesla would go to 130, you would lose 100%. So that's not great. And you would lose actually a lot before that and get margin called. That's the next problem. Margin calling means that you can be in a situation where you're long-term right and still lose enormous amounts of money. Because if Tesla drops too much, you get margin called, right? If Tesla drops to probably 220, I would say, if you're 2x leveraged with interactive brokers, for example, you already get margin called. If you get margin called, well, you're maxed out. If Tesla drops from 260 to 220 and goes back to 260, you were 2x leveraged with not much margin. You're screwed. You will have much less money if the stock goes right up where it started, because you get called down here, you have to force sell your shares, it goes back up, and you make much less than you lost down because you will go up with fewer stocks. That's the problem of margin calls. Now, so let's put this aside for a second. Your second option is short puts, which I like, but they are potentially even more dangerous, depending on how you do it. So short puts is basically you're selling put options. The pros, let's call them first, go into pros. You can create much more leverage. You can go easily 5x. You can maybe go 6x. So if Tesla goes down 10, you're making 50 or 60,000. But the problem with short puts is it's more or less also true that if they go down, you have the same leverage. So it's kind of a trick to massively increase your leverage. So you're basically buying puts out of the money that buffers your margin, and then you're selling in the money puts or at the money, whatever you want to do. The problem with that is, while on the pro side, you can get much more leverage here, and it's also hard leverage, right? You go hard up. You go actually up more than 100%. So if you have short 10 puts, which is the equivalent of 1,000 shares, you actually make more money than with 1,000 shares because you get some premium that also gets eviscerated. The cons are that you are dead even sooner or faster if the stock goes down. So that is very bad, because every time you have a hard leverage and make 50,000 when it goes up 10, you also lose 50,000 when it goes down 10. And you can do the math. If you have 1,000 shares, you have 260,000, the stock drops 50, you're dead. At 210, you lost 100%. So you need to be very cautious here. I will go in the end into what I do and why I like short puts in a slightly different constellation, and of course not 5x leveraged. But before we get there, let's look at scenario number 3, the famous leaps. So scenario number 3 and 4 are long calls, which have the huge advantage that you are not into the margin call problem and situation. And leaps are basically long-term calls out of the money. For example, 900, 800 strike end of 2026 or beginning of 2027. And there, you have much more leeway. You have more time, even though that's only true to some extent. And you have no margin call risk. So if Tesla drops to 220, if Tesla drops to 50, you don't care. You don't lose anything unless you sell. So if Tesla is at 260, you're buying leaps, and Tesla drops to 90, just for fun, just imagine. Nothing happens to you. Just keep your call options. They just lose 99% of their value or 95, but you don't lose the options. If next day Tesla then goes up to 260 or 300, you made money. You made a lot of money. So that actually relaxes you a lot compared to this margin call situation. But they also have cons, of course. There's 2 cons. First of all, your leverage is much lower. But if you really poor, if you sell half your shares and buy leaps, you have an effective leverage in the beginning of probably 2 or something. It goes up. If the share goes up, of course, you reach higher and higher leverage points. I will explain this in a second why this is. And then you have the problem. I mean, low leverage is fine, but the big problem is your time decay works against you as opposed to the first 2 options where it works for you with short puts. So if nothing happens and the stock goes sideways, or you're very out of the money, the stock goes up but not enough, you lose money. If you buy leaps now at 260 and Tesla goes to, let's say, 350 by September, you still lose money. So that's very tough to digest. These leaps work best if you don't keep them too long and you catch Tesla in a massive upwards move in their time frame. Then you win. Or if you keep them very short-term, Tesla just goes up 10 or 20, you also make nice money. But then you have to sell. I will go into this in a second. And the last option here is mid-range calls. And mid-range calls means, September 2025, so 6 months from now or something, September, November. Now, the potential here, why this is good, could be good. There's pros and cons again. If you do it right, this gives you very nice leverage because the premium you're paying is much lower. And we will look into this. We can look into this right now so you see these differences. So here's the options chain. Let's look at scenario 3 and 4. Let's look at leaps. Let's start with leaps. So let's look at January 15, 2027. That's a real leap, right? Far, far away from now. And let's look at super out of the money, 900. So you're paying $16 for this thing. Now, is this cheap? Well, it's not that cheap when you think about it. So if Tesla ends up at 900 in 2027 in January, at 916, you break even. If Tesla goes to 900 and you keep this, you lose all your money. Anything below 900, you lose all your money. If it goes to, let's say, 1,500, you make a killing, right? 1,500. The way to compute that is very simple. It's 600 above 900. So your call option will be worth $600. Now imagine you invest all your money into that call option and in 2027 in January, it ends up 1,500 and this thing is worth 600. I mean, it's very simple math, right? If you invest $160,000, it goes to 600, then you made $6 million. So you turn $160,000 into 6 million if you're right. But if Tesla goes to 900, you turn 160,000 into zero. That's the math. What makes it more complex is you don't want to keep this thing until the end. It's very unlikely that this is a great idea. And so, on the path there, the problem is, I give you a trick here how to compute this. Forget deltas and thetas and all these stupid Greeks because they're all synthetic, synthetically computed metrics. So they're all wrong. They're not reflecting reality. If you want to see reality, you better use something like this and say, well, what happens if Tesla is at 260? Right now, I buy this leap for 900 with expiration in January 27. What happens if I keep this thing for 1 year and in April 2026, Tesla is still at 260? It's exactly where it is. How would you know how much this is worth, right? 1 year of sidelining, nothing happens. Or it goes up and drops and you keep the leap. How much money do you lose on paper? Well, to simulate this, it's very simple. All you need to find is that same option with the same time to expiration as you want to simulate. So if you go, for example, and say, well, that is the equivalent, in 1 year of January 26, right now, boom, very simple. If you go to that option and you see something very shocking, that this thing is only worth $2.60. So you go down from $16 to $2.60. So your $160,000 that you invested is now worth $26,000. So that gives you a little bit of feel for, the problem of time decay with leaps. If you keep the leap for 1 year and the leap is January 2027, you will lose, I don't even know, like 85% of your money. But you will still have the leap. You will have the exact same amount. And if Tesla then actually goes to 1,500, you still make your 6 million. But of course, you would still think, oh, that was stupid because I could not have bought this thing, then bought it here, and then made insane amounts. I don't even know how much we have to, then you turn your 27,000 into 6 million, right? And that now leads us into the situation of the mid-range calls, where you have exactly that effect, right? So I will tell you what that all means in a second. But if you look now in mid-range and say, I want to actually do September 25, because I believe it's all happening now. It's happening in August, in June, July, and August, the big leap of Tesla. Then you can see you get very, very attractive prices. So you can buy a $400 call September this year for $12. Now, what does it mean? Well, if you believe that we launch in June, Robotaxi is a success. We show you have unlimited demand, basically always booked, right? You have strong margins. You have a reasonable price of $1.50 per mile or maybe $2 a mile. You easily beat Waymo. You destroy them. You destroy Uber. And your COGS are super low, like 30 cents, 50 cents. So there's a huge margin in there. Then the stock could go to 500, let's say. Maybe to 600 if you're lucky. If you buy this thing here at 400 for $12, it goes to 500. This thing goes to $100, right? So your 12, whatever, if you invest $12,000, you have $100,000. If you invest 120,000 into that call and it goes to 500, then you turn your 120,000 into 1 million, and so on and so forth, right? If you would buy this thing here, the 300 call that costs you $33 and it goes to 500, this goes to 200. So you turn, $32,000 into $200. So that's how you calculate that, at least if you would hold it through expiration. Now, what does this all mean? First of all, you should get used to this. This is option charts. There are many ways of looking at option chains. Always just look at the option, start with the endpoint. If at expiration, the stock is at X, how much worth is my option? It's very simple math. It's the difference between the strike and the stock price. The 300, for example, has the advantage that if Tesla goes to 320 by then, which is, that's a pretty safe bet, you only lose, 40% of your money. But if you buy this thing, you lose 100% because it's worthless. So, that's kind of the trade-off you have to do. What this means is all these options techniques. A lot of people are scared of options and I don't understand it. It's very simple. You just look at these things, you simulate the strike price, and you say, okay, are we directionally in a reasonable set of metrics here. Everything in options boils down to a very, very simple yet most complicated question. And that question is, what do you think where the stock will be at a specific point in time? And you have to find your own conviction, do your own research, listen to the right people, and really construct in your mind what is the most likely situation of the stock price at any given point in time, and where is your conviction the highest? What can we be sure of? That is why these 2030 price targets are so easy, right? Are we sure that Tesla will be at 11,000 at 2030? Not sure, but it's extremely likely. Are we sure it's going to be above 5,000? It's extremely likely. A lot of weird things would need to happen for Tesla not to be above 5,000 in 2030. But you can't make that much money with that because, what can you do in 2030? You can just buy shares and hold them. If you had any kind of specific information or triangulate the future sufficiently accurately to say, have a very high conviction that Robotaxi launches in June and it will be a success, there will be no hiccups and this works. That's where the real goal is. But I'm not saying we have that conviction 100%. I have it to like some percentage right now. I would say 70%, but there's clearly a 30% chance that something goes wrong. So the more you can actually narrow down the window of confidence into a specific time frame and then triangulate what's happening in this time frame and be right on it, the exponentially more money you make. That's very important. That's very important. The more you can narrow down the window where something is happening, and the more you're right about that something actually happening in this window, and the more you're right about predicting what it means for the market. Not just the more money you make, but the vastly exponentially more money you make. It takes a lot of people like a long time to understand that paradigm, what I'm saying here, but it's really true. If you would have 100% certainty about any share price of any stock, let's say in August of this year, if someone would travel in the future, come back and gives you 100% certainty, I saw the actual future, Tesla will be at $368 on, let's say, August 2nd, you could make enormous amounts of returns. I'm talking tens of thousands of percent. I'm not going to go into too many details, but certainty of the future with a specific timestamp on it gives you unlimited leverage, because then you can construct all kinds of things. And that's important to understand. Certainty and specificity are worth way more than just being right. So we have to learn that. That's why I'm so obsessed with talking to you guys and looking at everything and understanding what's actually going to happen. The prediction of the future with certain things happening in a certain time frame is the most valuable thing we can do in financial markets. So in terms of returns, what do I do? Well, right now I'm 50% in stocks in Tesla and 50% in Leaps. Not because I like to be there, but because the stock dropped so much that I needed to leverage up without leveraging up, without taking the leverage risk. And so I transitioned a lot into Leaps. And so far it looks pretty good because I did this mostly below where we are right now. But I'm a little nervous because this has to work out. I'm also doing always my little churn strategy, which is short puts. So if you have 1,000 core portfolio, I would be at the equivalent of 10 puts short, which is actually a lot, but I'm doing it slightly out of the money. To give you an example, I'm actually short 10, the equivalent of 10 Tesla puts at 270 strike, which is now in the money for puts. But I did it slightly above 270. So I'm underwater there right now. They expire weekly. So they expire on Friday. So for me, Tesla has to be above, I think, roughly 258 in order for me to make money. If it's above 270, I look very good. So I'm always doing that, but that's not my main strategy. That's just the alpha churn strategy that I shared before. And that's just a little side income to constantly churn through time decay on short puts out of the money, nearly at the money. I stopped doing that when Tesla was just on the slide down, because at some point it just hurts and doesn't do anything. So I started doing it like 2 weeks ago because I felt we are really reaching a bottom here. I think now is the time to start doing that again. But on top of that, I'm looking at Leaps, and I will look at more aggressive midterm options when the time is right in the situation. I don't think it's right yet because time decay is a huge deal, right? So even if Tesla has bottomed, and even if 250 was the bottom for now, if you have to wait another 4 or 5 weeks for Tesla to reach 300, you're much better off buying these midterm calls at 300. You get them cheaper than at 260 if it's 5 weeks later. So time is a big deal. And you want to be as close to the inflection point as possible, as late as possible. And, in order for me to miss out on the call options, Tesla would need to go up actually a lot over the next 6 weeks. So I rather wait a little bit longer. I think we get these premiums down even more. And I will only buy it if I feel everything is lining up right. Otherwise, I just stick with my leaps. And then you have to exit at the right point. So that's why we do some more videos on this. Holding options long term is always a terrible idea because there's just too much loss on time. So you want to always narrow down the holding period and you want to try to catch these inflection points and then on the run up, keep the options and then divest quickly. So be very cautious with options. Everyone I know who dabbled in options and got more aggressive with options, I always saw the same pattern. They make a shit ton of money early on, and everyone I know lost everything after, at least the first time. Everything means 90% or more. That might shock you, and I mean literally 90% or more, including me back in the days. And many people do this twice, and twice in their life lose everything, and then they stick with it, and then they learn it. So options are very dangerous, and you should not randomly play around with them. And you should always make sure you're putting only a limited amount of money into options as a percentage of your portfolio. Never go above your number, and your number, in my opinion, should not exceed 30% if you're crazy aggressive, because it's too easy to lose everything. And by the way, it's a long game. In most instances, people actually win tremendously in the beginning when they start options. So it's very unlikely you lose everything out of the gate. It's more likely you triple, quadruple, or fivefold your money if we would go all in. And then you lose it all because then you got used to winning and then you do stupid things. So you have to be very cautious. Only use money you can lose. Limit the amount of money you put into options. But I do think for everyone who really likes trading and gets really into Tesla, it's a good thing to dabble around with very cautiously, but you have to expect to lose all your money that you put into it because you will at some point. So I hope that was helpful. It's always fun to think about these things, but don't forget the key to option success is not options. The key to option success is to predict the future accurately for the underlying asset, which is Tesla. So hope that was helpful and see you very soon.